Hey, Daan here, and in this video we are going to talk about what metrics to track for the marketing campaign for your firm. So first of all, why should you even listen to me and take my advice? Last month alone, October 24, we spent about $50,000 on ads for accounting firms. We've been doing this for 5 years now. We've worked with more than 100 accountants. So I know what I'm doing, and I'm just making these videos to share all my knowledge so that you guys, the accounting firm owners, can just create the campaigns yourself and make a lot of money from it, so that attracting business owner clients is not a problem for you anymore. In this video we are going to talk about what metrics to track for your firm, and the reason why this is so important is because if you are basing your decisions on the campaign on the wrong metrics, your whole campaign is going to go into the wrong direction. So first of all, there are a couple of metrics that you can track. Things like cost per click, click-through rate, cost per impressions, of course cost per lead, but also cost per appointment, cost per qualified appointment, and cost per show, and also cost per client at the end of the day. Yes, it is important to track all of those things, but it's not the main thing. And the reason why it's important to actually focus on just one metric only is because that's the only metric that matters, and that's return on investment. Because I've had campaigns for clients where the cost per clicks were very low. The click-through rates were extremely high, and that's something that you want to see with all of your ads. But the cost per clients, for example, was extremely high, so the campaigns were still not really converting well. And I also had clients where the click-through rates were very low, the cost per clicks were very high. That's not typically something that you want to see with your campaign, but we are making a lot of money from those ads. So the main thing that a lot of accountants focus on is that they track and focus on the wrong metrics. I've had a client the other day that came to me and was kind of worried. Hey, I was looking at the campaigns and I saw that the cost per click was really high. And I just told her, okay, well, cost per click indeed is high, but this week alone we scheduled 3 meetings with business owners. And then she just started laughing, and she basically said, okay, well, yeah, I will let you do your thing. So the main thing to actually focus on for your campaign is return on investment, and not actually the cost per clicks, the click-through rates, and cost per leads and stuff like that. And that's also why it's important that you will have a very long-term vision, because if you are starting out with your campaign, of course you're not going to make a direct return on your investment. Of course you can still track and have KPIs, and that's of course very important. So for example, with our campaigns, we always want to have a click-through rate of about 4%. We want to have a cost per click in the beginning below $7.50. Later on we don't even look at it, to be honest, but it's just if you are starting out. Cost per lead, we don't even look at it, because you need to keep in mind that every type of service you are selling will have different cost per leads. If you are focusing on tax preparation services, of course the cost per lead and cost per appointment and cost per client will be lower than if you are going to sell fractional CFO services. So that's something always to keep in mind. However, it is of course important that you still track a couple of those things. So for example, if you see that your click-through rate is, with Google Ads for example, only 1%, then you know for sure that's either something wrong with your keywords or with your ads, so that's something you need to focus on. If your cost per click is really high, then it probably means that you are targeting the wrong keywords with a lot of competitors. So of course it is still important that you are actually going to look at the metrics, but it will not be the North Star. The North Star should always be return on investment. And that only takes time, because of course you're an accountant yourself and you know a couple stuff about business. If you are spending $500 on an ad and don't see direct positive return on investment, but you are trying to sell monthly accounting services for $2,000, $3,000, $4,000 per month, it's not very realistic to have a positive ROI if you are spending only $500. Also, if your cost per click is in KPIs below $7.50 in the beginning of the campaign, and if your click-through rate is above 4%, we also always strive for a landing page conversion rate of about 15%. So for if we have 100 clicks, we will generate 15 leads, and those are phone calls and form fills. It's very important that you also realize that if you are just running your campaign for like a month, those metrics will all be very low. Cost per clicks in the beginning actually are pretty low, but the quality of the clicks are also very low, and the click-through rate will also be very low, because the algorithms, this is with Facebook, Google, and basically every single digital advertising platform, they don't really know what type of users of the platforms are actually liking your ads and basically enjoy seeing the ads and click on it. So you need to realize that if you are actually going to run a marketing campaign for your firm, the metrics in the beginning will always be shit, because the platforms don't really know what type of people actually to serve those ads to. One of the metrics that we also track after we are running the campaign for like $1,500 or like 1.5 months, depending of course how much you spend on a monthly basis, is the cost per conversion. And it's always our goal to have a cost per conversion 15% below our typical goal. So let's say that we are running the campaign and we see that after month 1 we have spent $1,000 and the cost per conversion was $200, which is pretty high, but that's just for a normal starting campaign. And then what you want to do, you set the cost per conversion goal to 15% below the actual cost per conversion. They are going to start following the optimization processes that I explained in the last videos. And you want to make sure that every 2 weeks you are going to decrease this metric by 15%. So cost per click should decrease by 15% every 2 weeks. That's a metric to track. So typically click-through rate, cost per clicks, cost per impressions, we don't really look at it, and also the cost per conversion. But it still doesn't make sense. You can have a cost per conversion, so a cost per phone call, form fill of $1 and a cost per client of $2, which is insane. But if you are selling very cheap services, you are still not going to make a positive return on that investment. So you need to keep in mind that if you are selling high revenue services and you are advertising high revenue services, the cost will always be higher because the platforms know. For example, if you go to Google Ads and you type in the keyword affordable tax preparation for low income individual, a cost per click will maybe like $2, which is very cheap in the accounting industry. But if you are going to bid on keywords like fractional CFO service for Fortune 500 company, then the cost per clicks can be up to $200, maybe even $300. And that's only for a click, and you didn't even convert it. So you need to keep in mind that the metrics and the return on investments will always change depending on the services that you are actually advertising for. But in general, just have the metrics of a click-through rate of 4%. This also depends on what type of search platforms you are using, like the search partners that Google offers, and of course what type of keywords. But if you are using phrase keywords and exact match keywords, 4% conversion rate in the beginning and cost per click below $7.50. If you are going to switch the campaigns to max conversions, this is especially with Google Ads, then cost per clicks will actually increase. They can sometimes even double or triple, but you will see that the cost per conversion will actually decrease because the quality of the clicks will actually improve. So that's something to actually keep in mind. And tracking metrics with your advertisements is either at Google or Facebook or whatever platform you're using. It's not just black and white because there are a lot of circumstances and scenarios that you need to keep in mind. If you're running campaigns for a very, very long time, metrics will be different than if you're starting a campaign. If you are selling the services for tax preparation, of course the cost per lead will be lower than if you are selling bookkeeping or CFO advisory services. So you need to take a look at your campaigns. Take a look, okay, well, my click-through rate is extremely low. Maybe test some things with the ads. If you see, okay, well, now the click-through rate actually increased, but we're not generating the leads. Okay, well, probably something is wrong with the landing page. What is the conversion rate of the landing page? Okay, well, it's 2%. Okay, of course we need to make changes to the landing page. But you need to keep in mind, again, it's not black and white, because if you are going to think, well, the landing page conversion rate is very low, let's make changes to the landing page, but you actually forget that you also have bad keywords, then you're going to focus on the wrong things. So that's why, again, and I know that I'm kind of repeating myself, the main metric to focus is return on investment, because it doesn't matter. I rather have a campaign that I'm running and the cost per conversion, we are only generating 1 appointment per month, which is extremely low. But if all of those appointments are converting to clients that pay $2,000 per month, I'm happy to run those campaigns, because that at the end of the day is the only thing that matters. And another thing to keep in mind actually is also the lifetime value of your clients, because I once had a client and he came to me where he was saying, well, we have attracted this client and the client is now going to pay $2,300 per month. But we spent $2,000 on the campaign. It was just, the campaign was live for like 1.5 to 2 months, very early in the stages. And he said, well, how can I like scale this over here? And I just basically said, well, if we are going to get you those clients, one of those clients every month, campaign is basically free. But those clients will keep on paying you every single month. And you will get more and more referrals from those clients. And at some point, the results of the campaign are going to improve, and you will see that we are actually going to make way more money from the ads itself. So you will need to have a long-term vision. And in terms of calculating the direct ROI of your campaigns is kind of hard, but typically you need to take into consideration the ad spend, of course, also the time that you spend on it yourself, and the software that you use. There are, of course, also some other things to take into account, but those are the main things. If you really want to calculate the return on investment. And what our goal typically is to have a positive return on investment break even after 1 month of advertising after we get a campaign, and then a 10x after 2 to 3 months. And if you take in consideration that your clients are sticking around for a very, very long time, you can have a 100x on your investment, because if you are offering a great service, which of course you are, your clients are sticking around for many, many years, but you will also get referrals from them. That's why it's important to also, again, remind yourself that you can have a really good campaign, but if at the back end the prices are too low, or clients are not sticking around, or referrals are not coming in, then the return on the investment of those campaigns will still be on the lower side. So of course I will not create this video for you to only say that you need to run the campaign for many, many years and then take a look at the ROI. No, you can still take a look at the click-through rates. So if you are running a phrase and exact matches, it's the goal to have a 4% click-through rate after about a month with using negative keywords and phrase and exact matches. Then if you are below this, give it some more time. But if it's like below 2%, you need to really make changes to your ad copy. In another video that I recorded, I explain exactly how to create ads with Google Ads. Then your cost per click in the beginning, in the early stages, below $7.50 if you are doing manual cost per click with Google Ads. And you really need to focus on switching to max conversions as soon as possible if you have 3 tracked conversions inside of Google. And after that point, we don't even look at the cost per clicks anymore. We just take a look at the cost per conversion, and we want to decrease this by 15%. So those are the main metrics to actually take a look at. But again, you need to realize that you need to give it some time and data first. And at some point, you just only have to look at ROI. So don't blindly stare at the cost per clicks and the click-through rates and the cost per leads and even the cost per appointments. Only thing to look at is the return on investment. So after you've watched this video, what you can do is just go to your campaign, take a look, okay, well, how much did we actually spend? And just forget about the cost per click and the click-through rates. Then take a look, how many clients did we attract? And over their lifetime value, are we going to make our money back? How fast are we going to make our money back? And did we already get referrals from those clients? Because the last thing you want to do is that you are going to put your campaigns on pause while you are actually making money from it. So the last thing you want to happen is that you are running Meta ads and Google ads, and you actually see, okay, well, Meta, we are getting more leads. And then you put the Google ads on pause. Well, with Meta ads, yes, you are generating a lot of leads, but no clients. And with Google ads, you are actually getting clients. So that's why it's extremely important to track the return on your investment. So this is a quick video today. I've had a client that was asking me a lot about those metrics and what to track, so I thought it will maybe be helpful. So thank you so much for watching this video. If you like this video and you want the algorithms of YouTube to recommend you more videos about growing your accounting firm, leave a like. If you want to make sure that you're not missing any videos, I'm going to upload more videos about getting more business, tax and accounting clients, then make sure to subscribe. And you can also leave a comment and I'm going to answer all your questions there in other videos. So again, thank you so much for watching the video. By the way, if you are an accountant and you own an accounting firm, you want to get more high revenue tax and accounting clients, there's a link in the description. You can click on it just to see basically how we can help you. It's a free, no obligation growth session just to take a look at how we can help you without any obligations. But yeah, if not, just take a look at the videos and I hope you get a lot of value from it. Thanks.